Start.
Hi, we are Team 7, Tom Henrik, Shin, Minseok, and Hyemin, and welcome to our presentation about the mini case of Chapter 12, International Bond Market. So in this mini case, we are going to talk about a company named Sara Corporation. We will first introduce you to this case, and then talk about Eurobonds, and then apply the concepts to this case, and finally share our team's thoughts. As you can see on the textbook, this US company makes consumer goods such as Sara Lee cheesecake, Heinz pantyhose, Hillshire farm meat, etc. They cover from food and beverage to household and body care business. So we can say that Sara Lee is a diversified company in terms of products. One of the most important facts about Sara Lee is that this company is also geographically diversified, operating in more than 40 countries and selling products in more than 180 countries. So there's no doubt that Sara Lee has worldwide recognition in the market. In 1998, Sara Lee focused a lot on product and geographic expansion. Now let's talk about their financial strategy. Their key debt financing strategy is Eurobonds. They issue Eurobonds that have shorter maturity compared to other companies like Coca-Cola or Unilever. These two companies focus on issuing 5-year bonds, while Sara Lee focuses on issuing 3-year bonds. By issuing shorter maturity Eurobonds, which are fairly priced, plus the company's quite good credit ratings in the market, Sara Lee is attracting investors and raising funds in various currencies. In order to figure out whether Sara Lee is doing well with their financing strategy or not, we need to first look into the concept of Eurobonds and figure out how it is applied to the debt financing strategy of Sara Lee.
All right, so now I'm going to explain what is a Eurobond. A Eurobond is a bond where the issue is dominated in a particular currency, but it is sold in national capital markets which are different to the country that issued the dominating currency. So this might seem a little bit complicated. So imagine, for example, you're having a Korean company that issues Eurobonds which are dominated in US dollars, and those Eurobonds are sold to European investors, for example, in Frankfurt, in London, or the Paris Stock Exchanges. The name Eurobond refers hereby to the fact that the bond is issued in a different country than the currency's home country. But it is not related to the euro currency, even though the first Eurobond was issued by an Italian railroad company. Eurobonds are named by the currency in which they are dominated, such as US dollar Eurobond, yen Eurobond, or Swiss franc Eurobond. New issues are taking place in the primary market through a member of the selling group, and the bond may be resold before the maturity to other investors through the secondary market. The secondary market is an over-the-counter market. Okay, so now I'm going to outline the advantages of a Eurobond in comparison to foreign bonds. First of all, one advantage for the issuer is its flexibility of a Eurobond. The reasons for that are that the issuer can choose the country of insurance, which depend on regulations as well as interest rates and the depth of a market. Usually, their par value or face value of a Eurobond is comparatively small, so it's attractive for low-cost investments. And in addition to that, the Eurobond offers high liquidity, which makes it very attractive for investors to buy and sell them. It is especially attractive for issuer based in countries with small capital markets, because thereby investors are offered a high level of diversification. Eurobonds can also be brought to market faster than other US bonds because they are not offered to US investors and therefore don't have to meet the strict regulations from the SEC. Normally, Eurobonds are bearer bonds. Bearer bonds are bonds where the possession is the evidence of ownership. And this means that they are anonymous and therefore allow to avoid taxes on the interest received. Due to the tax avoidance, investors are more likely to accept the lower yield on Eurobonds in comparison to other bonds. As a result, the lower yield paid leads to a lower cost of debt service, which makes it more attractive for the issuer. As a disadvantage, it could be mentioned that Eurobonds can't be issued in the US primary market. Instead, they can be sold before maturity through the secondary market to American investors. And lastly, it has to be said that the Eurobond market is only accessible to firms with a good credit rating, which leads to a disproportionate in high credit ratings of Eurobonds compared to other bonds.
And then I'm gonna explain about the specific impact of Eurobonds when it's applied to the case of Sara Lee. Sara Lee has been rated AA- from S&P and A1 from Moody's Investor Services. Moody's A1 rating is 4 notches lower than AAA, which is the highest level. Even though it is much lower than the best, it still shows that the financial solvency of Sara Lee is strong enough for repayment according to the classification of strong payment capacity. Regarding the ratings, we reconfirmed that Eurobonds require a lower cost of debt services. The graph shows Moody's Season AAA corporate bond yield. At August 1995, Sara Lee announced about issuing Eurobonds for the first time. At the same time, AAA rated corporate bond yield was estimated as 7.57%, which is much costly compared to 5.881%, which is the yield of A1 rated Sara Lee's Eurobond. It shows the advantage of the Eurobonds that require lower cost, as we mentioned before. Now we're going to look at the brief financial statement of Sara Lee, so that how the issuance of Eurobonds affected to the company in terms of their finance. To analyze the impact of the issuance of Eurobonds, we analyze Sara Lee's financial solvency by comparing interest coverage ratios before and after the issuance. The interest coverage ratio is calculated by EBIT divided by interest expenses. Briefly, a higher ratio indicates a better financial health. We could find out the ratio were increased after issuance in 1995. Even though the interest expense was $62 million increase within 5 fiscal years, the interest coverage ratio increased 0.819, which is about 11.39%. We can interpret this phenomenon as Sara Lee's financial stability has been improved even after the huge issuance. The low cost of Eurobonds has contributed to lessening their burden than other kinds of bonds. Since the company announced that they would use the proceeds for general corporate purposes, their effectiveness and efficiency on their operation would be improved. The above financial summary shows that the company continuously increased their net sales. During the period after issuance, there were some fiscal year finished with net loss of normally. As shown in the income statement, 523 million net loss has been recorded at 1998. We look for the reason for such a situation while worrying that it has been caused by huge borrowing. However, the restructuring charge of the whole company was the only reason for this loss. As notes to financial statement mentioned, since the restructuring was a decision for change of corporation's strategic direction, we concluded the issuance of Eurobond has nothing to do with that loss.
As I mentioned earlier, good credit ratings are necessary to issue Eurobonds, which Sara Lee is capable of. Besides that, Eurobonds tax avoidance on the receiving interest attracts foreign investors, thereby enabling the corporation to save debt financing costs. This issuance of Eurobonds is also supported by the figures shown in the increase in Sara Lee's interest coverage ratios, as well as increase in net sales and income, indicating the improvement in financial stability. Higher flexibility makes it easier for Sara Lee to raise funds in various markets, which is also suited for their restructuring and expansion strategy regarding worldwide manufacturing and operations. Considering the mentioned points, Sara Lee's position in the international market and their strategies make their focus on Eurobonds an effective debt financing strategy. Thank you for watching our presentation, and please feel free to share your opinions in the comment section. Thank you.